Joining us now is Pankaj Pandey, the head of research at ICICIdirect.com. Good morning, Pankaj. So, look at the comeback we saw yesterday. It was a far more decisive comeback led by the heavyweights, Reliance Industries in particular. Even ITC managed to move the needle.
Expected in Europe. Now, coming to something like ITC, we have seen that a lot of dividend yielding stocks have started to sort of do better, be the likes of Coal India or ITC. And I think, given the fact that markets have been volatile, companies, the earnings. Yeah, hi, good morning. So I think, Reliance, I think, or refineries in general are expected to benefit from the expansion in cracks for diesel spreads which have come out, largely because of the shortage, which is, of these companies have been sort of stable. So that way, I think there is a sort of a preference in this entire kind of a volatile scenario as of now. But overall, our sense is that markets are likely to sort of consolidate at higher levels. And I think you have sectors like IT, which are sort of looking structurally a lot more better, given the fact that a lot of sectors are expected to witness margin pressure going forward in Q4 and a quarter after that.
Those are a couple of stocks which were buzzing in trade as was the broader end of the market. In fact, more than the Nifty, it was the broader end of the market or the broader market in itself which saw a steeper recovery than what the large caps were doing. So after being well in favor of the Reds to start off trade, they made a very meaningful comeback, finally closing with a count of nearly about 130 stocks within the F&O segment closing in the green. And a lot of them were holding up: Rain Commodities, Birlasoft, JNFC, larger boys like Tata Motors, Techem, of course, were big price performers. And aside of that, I'm just going to drop the entire list. There was also an L&T Finance, Bandhan Bank, which has had a great run last week, held out yesterday as well. There was BPCL, Jubilant Foodworks, there was Bharat Forge, IOC, LIC Housing Finance. The list of gainers was pretty endless. And Pankaj, once again, that pre-COVID trade of specialty chemicals after this recent correction once again has made a comeback. What to your mind is standing out within the specialty chemical space, if you could name any stocks?
So within the specialty chemical space, we like two companies. One is Navin Fluorine, given the fact that the level of chemistry, what they do, and the kind of integration they have. So that is one stock which we like, has been part of our portfolios, which we have been recommending on a consistent basis. Then I think Neogen Chemical is another company which is looking quite interesting, even from a future perspective, given the fact that they're looking to play some role in the lithium-ion batteries as well going forward. So these are the two names what we are sort of liking from the specialty chemical space. But having said that, we are still not very sure the kind of margin pressure some of these companies or the sector in general is going to face in Q3 and Q4.
Okay, I just want to bring up the chart of Reliance Industries as well, considering this was single-handedly responsible for the kind of scale-up and recovery that you had in the markets. So sure enough, it's still off from its 52-week high of 2750 thereabouts, but it's not bad going, you would say. 2500 is back on the ticker for Reliance Industries. Having said that, Naresh, we've seen Reliance be stuck in that range for almost, 6 months now. When is it that we can see a meaningful attempt at its 52-week high and maybe 2700 beyond as well?
So if we look at the prices pre the Russia-Ukraine crisis, 2250, 2300 was a base. We held on to it. We just went below it for a couple of sessions and then we have recovered well. And now we are back to testing the 2550, 2570 mark, which has been a resistance for the last 3 to 6 months. I would expect the move to have already been started and we are heading up towards a new 52-week high. So out here, any dips from here on is a buying opportunity with a stop loss below 2400 and expecting first to move towards 2750 to 2900. So I think we could be making a new high over the next few weeks also, possibly on Reliance Industries.
Pankaj, is there a trade in HPCL, BPCL and OMs and IOC? And the reason I'm asking this because, Pankaj, there was a fear in the market that government did not increase prices after the UP election and everyone thought that are we going back to the old oil regime? But that in a sense is now getting negated because prices have gone higher. Do you think there's a trade in a HPCL or a BPCL?
So fundamentally, we have given a buy rating on some of these names, but I think the best play in this refining space would be Reliance, given the fact that they are one of the biggest exporters, especially of diesel, and we have seen the diesel spreads sort of nearly doubling in a shorter span of time. So I think that will be sort of the biggest beneficiary. The challenge with some of these OMCs is that while we would see incremental price hikes, but I mean, in terms of whether they'll be able to sort of maintain margins, especially on the marketing side, is again a sort of a challenge. And so which is where I think Reliance sort of suits the bill, most of counts. So which is why I think Reliance is the sort of best pick if somebody is looking at higher refining margins and that sort of leading to better top line and bottom line growth. So I think Reliance stands out.
2531 for Reliance Industries. It's interesting that we're speaking about Reliance and we are not talking about Adani group of stocks. Let's look at how Adani group of stocks have actually moved in the month of March. Adani Enterprises, we look at Adani Gas, Adani Green. I mean, this has really been the phenomenal wealth creator for shareholders, this entire group stocks. So if there is one success story, if you have to talk about how things have moved in terms of the post-COVID scenario, I mean, the re-rating in Adani group of companies has been absolutely mesmerizing. Naresh, even though the Adani group of companies are the poster boys of this bull market, I think the bull market is still intact. Naresh is not there. Pankaj, what do you like within the Adani group?
So we have very limited coverage within the Adani group. Adani Port is something which we have been liking for quite some time, though the stock hasn't really moved in the past 5-6 months. But largely because the import volumes have been softer, and that has led to sort of lower volume growth at the port level. But having said that, I think the company is sort of strategically placing themselves quite well for the manufacturing opportunity which is going to unfold with the kind of capacity what they're looking to sort of create on the port side. Even on the warehousing side, they're looking to have a 25% market share of the overall entire country. So from that perspective, I think this stock looks very attractive to us and has been, and we've been sort of recommending and is part of some of our portfolios as well.
Right, okay. In the meantime, let's also take stock of what was not working well yesterday, and that was clearly the entire FMCG space. No surprises here. Everything from a Britannia to a Unilever to a Nestle were underperforming. And I guess the reasons are pretty evident here, Nikunj. I mean, we were chatting with Sunil Duggal just yesterday, as well as Technopack Advisors as well. And they all said that, inflation is at its peak right now in terms of input costs, and B, this is not just an outcome of what you're seeing between Ukraine and Russia. I mean, inflation has been weighing heavy on FMCG margins for like 2-3 quarters now.
And it's not going to go down in a hurry. Aisha, just imagine wheat prices, Ukraine. I mean, that is in a sense the wheat producing region, at least for Europe.
Yeah,
we know they say wheat sowing is not going to happen. If wheat sowing is not going to happen, I don't think there is a lot of excess stock, wheat stock or food stock in the world, and which means that somewhere wheat prices will go through, inflation has already kicked in, you will actually go through a bout of shortage. So if you're an FMCG company, if you're in biscuits, if you are in food, obviously the spike in, let's say, wheat and other categories will have impact on you. Now, if inflation was one reason to get perturbed about, well, think again, there's one more reason, which is that this time demand is not there. So it's a double squeeze, double whammy, difficult time. But the bottom line is that for some of these stocks now to sustain these lofty P multiples when the business per se is contracting is going to be a derating moment. Derating for the P multiple and derating for the stock prices per se. You have normally seen, Aisha. So Aisha, let's look at what we've seen in FMCG companies in last 10 years. You've only seen them battle one side, which is inflation. You've not seen them battle the demand side. In India, you never have a demand problem if you're an FMCG company. But for the first time, there's a demand problem and there's inflation problem.
In the rural economy.
Exactly. So,
and to think of it as a consumer, you and I may not behave in that way, but when everything from fuel prices to just about everything that you're buying as a consumer is getting expensive, you will get you will cut corners, you will get price price conscious. Let me not buy that expensive cookie. Let me go for the cheaper one or any other.
No, I mean, price hike will hurt all of us, Aisha.
Yeah.
I mean, it is hurting all of us. I mean, let's be very, very clear. So, could there be down trading, which is that you go down the quality curve? Could there be that you buy the same but you buy less? But the consumer behavior is going to be strikingly different from where it was, and that is something which I think markets are aware of it. So what we're discussing, markets are aware of it, but I think the stocks are not pricing in that assumption yet, because if you look at the P multiple of a Nestle or a HUL or an Asian Paints or even Britannia, they've come off, but they're still above 50.
Yeah. Pankaj Pandey, that's why do you think there is further headroom for these stocks to cool off? Because the valuations don't seem to be indicating right now extreme pessimism. And, you know, we were just reading and going through some reports on what Unilever management had actually conveyed to some of the brokerages when they met them. And they all indicated that it's, 1 year of earnings pressure at least that we're looking at ahead.
You're right, Aisha. So I think what we are seeing is up till now is sort of a mid-single digit kind of a volume growth, and the pricing pressure was already there. And now with the increased commodity prices, whether it is agri commodity or crude-related value chain, I think the prices have gone up, and so we might see some bit of a margin pressure in Q3, but I think Q4, and bigger margin pressure in Q1. Now the challenge is that you cannot really do the price hike and expect demand to sort of remain robust, and which is why we are seeing softening of P multiples. Even the earning growth trajectory is also expected to be softer, both on the top line as well as bottom line side. And we have seen prices sort of correcting. Our sense is that probably we might see more of a time correction going forward, since we have seen both timing as well as pricing correction as of now. But it looks unlikely that some of these or most of these names are going to sort of outperform the market. Even for a category where volume growth has been very high, for example, take the case of paint. I mean, paint companies have already taken 20% price hike, and if they have to take 5 to 6% bare minimum price hike to maintain margins, we are sort of worried that it will have an impact on the volume growth, and which is why we've cut earning estimates by 14, 15 odd percent for most of the paint companies, and this is true for a number of other sectors as well.
Point in time, you would say that what you and me are discussing, markets have already factored that in. What would be that level for a Marico or a Asian Paints or an HUL or a Nestle, where you would say that now the bad news is in the open? I mean, this market, for example, I'm just using it for the benefit of our viewers, that sometimes markets bottom out at the peak of the panic. 2020 markets bottomed out when there was peak of COVID. Have markets bottomed out in the month of March when there was peak panic? Crude at 130, war in Ukraine, Fed increasing Fed increasing rates. So Pankaj, my question is that what is that price point where you would say that assumptions what we have are baked in?
So, Nikunj, from a market perspective, I think largely the bottom has been made. We would not expect previous levels or panic levels or to be sort of revisited, because we've seen both VIX cooling off domestically and globally. But having said that, what we are expecting is a sort of a slower grind at the higher level, given the fact that we have only few sectors which are not going to get impacted from this overall trend of higher higher input prices and consequently margin pressure. And this margin pressure is going to sort of remain elevated even till Q1. So, which is why structurally we would not expect markets to sort of do that great. But yes, you have pockets like IT, which is not expected to sort of face margin pressure. Then you have a segment like banking, where we haven't seen much of a price performance. So these are some of the pockets which are likely to sort of anchor market higher. And same is the case with oil and gas sector, especially companies like Reliance. So from that perspective, markets could still trend higher, but a larger portion or a good portion of the market might sort of grind at current levels. And unless and until we don't see any kind of a cool off in these commodities, further run up probably may get paused. I mean, to highlight as, for example, a company like cement as a sector. I mean, you really need 15 to 20 rupees per kg kind of per bag kind of a hike. and it does not look like companies can undertake that hike. While Q4 we might see 100 bips margin pressure. In Q1 we are expecting about 400 bips kind of a margin pressure. So the prices remain at elevated levels. So obviously there will be some challenge, but compared to that, if you look at a segment like say hospitality, I think that is one segment where we are seeing occupancies and ARR improving for both leisure as well as business restoration, and that is clearly sort of reflecting the change in trend of the consumer buying behavior as well. So one needs to be very sort of quite choosy in terms of which sectors or which segments to sort of look at, because there could be a wide sort of a divergence between the performance across sectors.
Shift gears and ask you about Paytm. Now that stock has fallen below 550 rupees a share. It's down 75% since the IPO price, more than 35% in the last 1 month alone. The BSE in fact even sought clarification from Paytm about the volumes and the moves that we're seeing on the stock. What's your call? Just the way it's going down and so fast?
So I will not be able to sort of comment of the recently listed companies. EaseMyTrip is a stock which we have been liking largely because of the shift in consumer preferences towards travel and tourism. The other what we have covered is Star Health. So I think healthcare as an industry, since COVID is largely behind us, we would want to believe that this segment can sort of do well, and we have seen decent amount of price correction. So I think these are the only two stocks which we have recently sort of covered. Rest of other names, I think if you're trading at 20 to 30 times sales, we really do not have a confidence to sort of recommend or track those stocks.
Right. And Naresh, I'm going to come to you and I'm going to ask you about Indian hotels. The stock will be in focus because of the QIP. We were just talking about the reopening trade, the way India has outperformed the rest of the world 2 years since the strictest lockdown on this planet. So when we talk about the reopening trade and Indian hotels in particular, which will of course be in focus because of the fundraise exercise.
So Indian hotels has been under pressure because of this overhang which has been there for the last few weeks. And if you look at the stock did not make a breakout or a breakdown move for the last almost couple of months. It is around that 200, 210 levels. So once this overhang is over, I would expect it to eventually break out above the 230 mark, go towards 260 to 300 in the medium term. So any dips closer to 190 to 205 zones continues to be a long-term buy area. The stock has made a strong bottom around that 180, 85 mark. First in December, Jan 2022, then again in the Ukraine-Russia conflict date. So overall, structurally setting up for a big breakout eventually. And also the stock used to be 160 rupees back in 2006. So it's done nothing for the last 14, 16 years. I think the whole cover up should eventually happen. I would be looking out for a momentum buy about 215 levels, and on dips at 205 or lower would be a good opportunity to get in. So like the stock for the long term, the charts are very interesting. Whenever a stock breaks out of 15 years, over the next couple of years, it can continue to surprise.
Right, so that's as far as Indian hotels goes. Before we go any further, here is another fundamental idea. It's coming in from Chakri Lokpriya, and he's talking particularly about real estate counters. Listen in.
You know what, in this quarter, until this quarter, they're showing very good numbers because they've been showing, they're kind of clearing out their existing inventory. Now going forward into the next quarter, next 2 quarters, depending upon and their raw material costs, which is steel, cement, all their costs have gone up and gone up quite significantly. It will go up by at least 10-15%. So now the question is whether they do have the pricing power to pass it on. It's unlikely that they will be passing it on, and therefore the margins are likely to be hit. Now these companies were trading at below book values some time ago, but not anymore, and therefore it largely depends upon how fast will all the input costs come down for real estate companies. But currently, it looks like it's unlikely to come down for the next 2 quarters. I think so. Individual plays like Shoba, Phoenix, these are the companies which are stronger companies which are likely to do well. But as a even DLF actually has cleaned up its book quite well, so it will also do well. So I think it's more stock specific, but as a sector, they will face raw material input cost pressures.
Okay, now that's the SGX setup for you. It's all green. Now, frankly, I'll admit, yesterday when we walked into trade, the odds were not that favorable. Crude had gone up, FI selling was there. Uh, it appeared on the war front that the war is going to be getting prolonged. So none of the factors have reversed. FIs are still, they're not selling aggressively, but it's not that they've turned big buyers. Crude is still above $110, and the war, nothing update, no new update. If at all you know that the war is going to prolong, then why are markets going higher? Is it one of those phases where everything is out in the open and markets have managed to climb the wall of worry? Was there peak pessimism in the month of March, and have we gone past that point of peak pessimism? So Kunal, this market was supposed to make a new high. That is what the technical setup looked like post budget. That setup was challenged. Are we likely to retest a new high? Now, whether we go past that, that's a separate question. But do you think there is enough momentum in the market based on yesterday's and last week's price action that this market will surely take a shot at the previous high?
So looking at the very recent construct, it's going to be a bit of challenge over here, Nikunj, because when you look at so there are two parts to it. One is the momentum on the Nifty. Now we've seen very strong pullback on the indices, with very good recovery on the Nifty from 15,600 to 17,300, 350 where it closed yesterday. So I think in that regards, it's been an excellent comeback for the Nifty. But when you look at across the board, across the sectors, there are so many sectors which are still reeling below their long-term averages, and there have been not many major recovery into these names in terms of sector front. So look at Bank Nifty, for example, trading below 200 DMA. Look at Fmcg index, Pharma index. Even the IT stocks have not seen a major pullback. Now, if we required the markets to make a fresh high, we would need at least few of the leading sectors. I would say at least 30%, 40% of the sectors starting to make a fresh high for themselves. At least as of now, we have not seen any major signs coming across where these sectors have made any decisive pullback for themselves or recovery for themselves. So that remains to be a bit of a challenge, and I think that would probably also indicate that the pace of rally on the upside would slow down significantly, because you would need a lot of sectors to make a comeback first, a lot of individual stocks to make a comeback first, and then once that happens is where the market setup looks strong for a fresh high. So I believe it's very difficult to call it right now till the time we don't see any major sector patterns picking up as of now. Bank Nifty and I believe the overall financial services index, even the auto stocks, which were one of the, I would say, the leading sectors since the start of 2022, specifically the first month. I think from there, these are the two important sectors which can probably lead the charge from the front, because if there is any major pickup into these names and you see a fresh breakout happening for many of these auto as well as the banking names, then we can call in or anticipate that the markets can head back towards a new high for themselves. So we'll have to take it step by step. As of now, I believe if the indices sustain this momentum, we could be looking at a new range, 17,750, 800 on the upside could be a broader range on the upside. And on the support, we should be looking at 17,000, 16,900 as a fresh support on the Nifty.
Okay, Naresh, a simple question. Is there enough strength in this current rally or pullback that there is a chance that a new high could be attempted? Naresh.
So my viewers doesn't have that much strength, doesn't have enough strength across the board in terms of the constituents. So I would expect it to pause around that 17,600, 800 mark, maybe a little more extension above that. But there is not enough strength because there is no leadership in terms of stocks which have high weights. So the Bank Nifty, for example, is still struggling to cross the prices which was there pre-Russia-Ukraine invasion. So out here, it's a case of where we need to gain up more strength, consolidate before we can start that march to new all-time highs. And we do not get into V, so the markets do not have a tendency to get into V-type moves wherein we fall from 18,000 to sub 16,000 and again go back to 18,000 quickly. So I think going forward it could be sideways, and there could be more stock specific action in the mid caps, small caps, new themes playing out, but the index does not have the strength to make a new all-time high so soon.
Let's just check in on some of the other buzzing stocks. IHCL, of course, is in focus with that QIP detail coming out. There's TCS buyback also, which closes today. On day one, it already got subscribed by about 5.5 times. So a couple of these stocks continue to be in focus. TCS, of course, was a winner yesterday as well, as has been the case with some of the mid-cap IT names too. They too have moved up with the large-cap names. That said, what did not go down well, I think, was Nikunj yesterday's Z. I know we've not talked about it, but that was quite a bit of setback, and that reflected on the stock as well when it fell 3.25%.
No, that's largely because of the news, and I mean
Yeah.
the news, in a sense, now there is another level of suspense whether the deal will go through or not, because now it will go to the Supreme Court. Depending on what you hear from Supreme Court, the next course of action would be decided in a stock like Z. But media in general, excuse me, has done rather well. You keep Z aside, that's news specific, but look at TV18, you look at TV Today, throw in Sun TV. Media in general has done well. I mean, just like all sectors are rotating, ITC has made a comeback, SBI has made a comeback. Media is one sector which, in fact, in last couple of years has not given any returns. And could the second half really belong to media? As the economy will normalize, as things will start moving higher, most of the news media companies now have got strong presence in the digital space as well. A classic case here is something like NDTV. So media companies in general have made a comeback, and this year maybe this year. Let's take this TV aside, but look at TV Today, India, NDTV, some of those stocks, TV18, some of those stocks have done rather well for themselves. Pankaj, give me a list of 1, 2 or 3 names where you think that these stocks can easily double in 3 years. Maybe more than double in 3 years.
So is it you're looking at pertaining to media or?
No. Just give me names. That's what I think our viewers are interested in.
So we have been liking a number of names, right from Ease My Trip. We like Orient Cement, given the fact that a company over the next few years is going to sort of come down or will bring their debt significantly down. Then I think I'm sorry, you sort of put me in a spot. I'm sort of, so I think we've been liking a number of logistics names, right from TCI Express. So these are the names where we feel can sort of potentially double. Then I think so nothing from the FMCG or these kind of names, but I think. So I can probably come back. I really don't have an answer as of now for though we have a list of stocks which we sort of recommend. It's just that I'm sort of blanked out.
Okay, Kunal is in studio. Hello. Feels like a normal life.
2 years.
Almost 2 years.
Almost 2 years.
Almost 2 years. And look at where markets have gone.
We were just discussing that today was, Kunal, you would actually be the best place to talk about it. Today was the 2-year anniversary of the Nifty all-time low, or COVID low actually.
23rd of March, I think was the time when we hit that 7,500.
Let's take the clock back actually. And I distinctly remember, my jaw dropped when that market was almost circled down in the morning. Not that I've not seen it before, but those are those numb feelings which you get. Oh my God. I was reasonably confident, and I think it would be good to see the tape out. We'll try and pull the tape out actually.
We should do
it's a hint to my producer that we should have prepared it in the morning.
Right? There are no tapes now.
This is where age and vocabulary does not change. Started in era when tapes were there. Yeah.
We
so
should bring
Patricia, my producer,
that clip out.
I'm going to tell her right now, request her that please get the tapes out. We should have prepared this in the morning, but it's a good idea now. That's what happens in digital, but you get an idea and you implement it right now.
But it's very rare, I remember 2 years back, 2 lower circuits. We had hit 2 lower circuits in a matter of, I think, just 5 days or 4 days. And it was, when I used to talk to people outside across different parts of the globe, it was everyone was in in a state of shock.
Yeah.
Like, what is going on? No one knows.
You know,
and now where we are right now, everyone knows what is going on.
where I look back and I say that, with all due respect to Warren Buffett, he did not buy the fear of COVID crash, and that in a sense still remains a puzzle to me. That a man who's mastered the art of buying fear, why was he not buying in US stocks, or why was he not investing in US stocks at the peak of the fear? So you live and you learn. But I think, and interesting part, Aisha, is that when the Prime Minister announced the lockdown, that marked the bottom of the market.
Yeah.
Here's the big lockdown which comes on the
I mean,
nation.
to be fair, he prepped you with the Janta curfew. Remember that one Sunday? So he prepped you
He prepped you,
for
but look at
the
market.
big lockdown.
Look at market. I mean, the peak of the bad news, you know that the economy would move into shambles.
Yeah.
The graph is going to drop in a linear manner if there is a 21-day lockdown, which actually happened.
Yeah.
And we know the economic impact of that. And the market bottomed out the night or the day the announcement was made by the Prime Minister. It was like it was in the evening about 7:30. Sampurna lockdown.
Yeah.
That was the word by the Prime Minister. And the next morning, markets opened lower and they went
Then
up.
they recovered.
That's it. Wow. But that's the beauty of the markets, right? They
Absolutely.
always act in anticipation of an event.
Absolutely.
And way ahead of the time.
That's why we typically say buy the rumors and sell the news, because the market moves in a manner in which we believe that the news are not factored in. But once the news gets factored in, once the market knows that the risk is out, that's where new trend gets emerged.
Yeah, okay. So I'm going to hand it over to Avan. Let's get some ideas going for today as well. We'll keep talking about and reminiscing as to where we were and what we were doing and how we reacted to that nifty low of 7,500. But Avan, the pre-open rates?
Yeah, and just look at the rates that we're, checking out on the screen today. What a far cry from what we witnessed those 2 years ago. So yes, we've opened in the green. It's 125 points higher on the Sensex this morning. You've got the Nifty as well mirroring the strong global cues. So holding out in the green. In fact, inching towards the 17,000 400 mark as well as we speak, are looking smart, up by about 0.2%, but it's a bit of a tentative start. Let's find out some mid-cap strategies then and connect right back with Naresh. And Naresh, what is it that you're spotting on the chart?
I'm going with the opening up theme, which is where we look at Mahindra Holidays. The stock has given a clean breakout yesterday with very strong volumes. So yesterday was a big volume jump up, almost 5x to 10x volumes. The stock was range bound for the last 2 months between 200 to 220 roughly. Yesterday the stock closed well above the 200 to 220 mark, a big volume jump up, and I would expect it to first move up towards 280, very close to the price point which it was a few months back. A stop loss at 217. Overall, the whole hotel pack looks interesting, and this is again another hospitality bet which looks promising for the short term as well as for the long term.
High flyer yesterday, and Naresh believes that it has more legs, and it's a buy recommendation at the current levels as well. Okay, Kunal, it's the open up theme that Naresh has been harping on for quite many days. What about you?
See, I believe the banking stocks should make a strong comeback for themselves. The markets have to sustain this recovery. So one of the stocks which has done reasonably well, recovered, even from the Feb lows for itself, is Federal Bank. So the stock is now nearing a breakout of this 3-digit mark for itself. My sense is that the stock has shown admirable strength over the last 1 to 2 months, even at a point when there was heightened amount of volatility, and made a very strong comeback for itself. So it's a list of buy on Federal Bank, 106 as an immediate target, and stoppers could be kept at 96.
Kunal, one thing I wanted to ask you was, and we talked about this a lot, right? With the year, start of the year, we were like, when will the financials move? Then they finally moved. Then there was a sell-off. And now they seem to be making a comeback. What's your call now when it comes to the bank nifty? And yesterday also we saw the private sector lenders have a really good day in trade.
So I think when you look at this in the last 7 days of context, then yes, the recovery for the banking stocks is much stronger than what we've seen earlier, because it's been led by a whole host of private sector banks. HDFC Bank has recovered more than 15-16% from its swing lows. ICICI Bank has also done very similar kind of a price action. SBI has also led the charge from the front. So a lot of large cap names leading from the front. Earlier, when the bank nifty started off this year 2022, it was more PSU banking names which are doing the major part of the workload for itself. So this recent strength which you've seen in the private sector banks is something which is going to be very interesting. And I believe there could be a case that the change in the structure for the internals of the Bank Nifty could lead to a decisive change of trend. So my sense is that the Bank Nifty should try and outperform from current levels if you'll start to see a stronger set of outperformance from the large cap private sector banks.
So basically,
What about you? Because the Bank Nifty yesterday did cross 36,300. So love to get your views on this. And just the way Kunal was talking about the changing constituents.
So if you look at the way we are looking at it Nifty in terms of what we are shaping up for is a period of consolidation. We don't see leadership in any of the constituents as such. So Reliance Industries, the largest to it, is the only one which is taking leadership. IT and pharma are getting into a period of time where there will be selective moves. So in pharma, at least the larger names are breaking out, but the weightages are too low. So in the end, a new high on the Nifty requires a big move happening in the Bank Nifty, and we're waiting for that to get started. Whenever that happens, multiple starts over the last 1 year have been tough. We got the second wave when the Bank Nifty was starting to take leadership. We've got Russia-Ukraine crisis right now. So waiting for that move. Right now is a time where markets could go nowhere before we start making a move back into a big trend. So for now, the view is stay extremely stock specific. The index does not have a lot of legs at these prices.
Okay, I'm going to now go across to Pankaj Pandey for our new segment that we've been having on the show, What's the Cover? And today we're putting the spotlight on Maharashtra Seamless. Pankaj, what's the cover when it comes to this stock?
So when we just look at Maharashtra Seamless, there has been an disclosure regarding promoters increasing their stake in the company. The stock also, along with other metals and steel names, have been one of the buzzing names in the last few days. Now, what I can pick up is that in March 2022, which is the month that we are currently in, the promoters have upped their stake. They have upped their stake in multiple tranches, and closer to about 2.4% is what they have done on the higher side. So that's the number that one can actually see. Their earlier stake as of December was close to 64.8%. So you can add this, it becomes slightly higher. This is a seamless pipe company that we are talking about. It's owned by one of the Jindals from the same family, and they have been upping their stake. The stock earlier used to trade much higher, but it's corrected off late, and this was an interesting thing that why the promoters are increasing. So the buzz on the street is that promoters have been increasing, price is looking attractive, and that's one of the key reasons why the stock has been buzzing of late. 2.4%, that's a substantial amount which promoters have increased so far.
okay, Maharashtra Seamless, and that's the big buzzer that we're talking about and we're picking up news on. In the meantime, just looking at the texture of the market, yesterday it was a few odd stories like a TechM, Tata Motors, Reliance, of course, did the heavy lifting. And besides that, there were unusual names like ITC, which also moved up today. I don't know whether it's going to make it to that 270 odd level or not, but 250 thereabouts is where ITC is right now. I think we'll just bring up the intraday graph. Yeah, 251 thereabouts. That said, it's really been all about private banks. ICICI Bank, IndusInd, they all held out quite okay. Kotak Bank as well did the trick yesterday. Fmcg did not. Some of the metal counters did not, and oil sensitives like Asian Paints continue to react pretty much on a daily basis on the movement on crude. But for the direction of the market to move up from here, Kunal, what's more critical now that Reliance as well has suddenly begun to participate? Would it be Reliance? Would it be IT? Or would it continue to be banks?
See, I think we've ticked a lot of boxes. We've ticked a lot of boxes in terms of large caps performing, strength coming back across global markets, fears across the news flows abating. So I think all of those are fine. But when we look at our market internals, every new trend, every new high for the indices is led by new sectors. Now we'll have to wait out for which are the sectors which are leading the breakout. 2020 we had IT. 2021 mid we had the banking stocks doing pretty well. Now which are the kind of sectors which can lead the breakout? Like for example, metal stocks have done reasonably well, but somehow in the last 2 weeks they've gone a bit more quiet for themselves. Now if these metal stocks are the ones which are leading the breakout, or you have new sectors which are leading the breakout, that would determine that how strong and sustaining this breakout could be for the indices. So
and within metals, is the leadership still with Tata Steel, or is it some other name which is looking
it's Hindalco,
stronger?
which has been a top performer. Vedanta comes next, and then you have Tata Steel In fact, JSW Steel, which had done reasonably well since last 2 years, is actually underperforming the other large cap makers.
No, it's interesting that Tata Steel is underperforming.
Yeah. I mean, I just assumed it would be Tata Steel. I didn't even realize it would be Hindalco.
There's some big seller in Tata Steel, and I'm surprised. I'll tell you why. Because see, where is the disruption in the world? The disruption in the world is in Europe, and in Europe, who has the largest presence? I think it's Tata Steel, both in terms of presence and also in terms of a plant which has touchwood not got disrupted. It's only the plants in Ukraine and Russia that got disrupted. Tata Steel has no presence there. Now, Russia is a large exporter and Ukraine is also a large exporter of steel. And that steel goes off the market, and Chinese steel is already off the market. US is wanting steel. Where will steel go from? Either it will go from Europe or it will go from India. These are the large two producing nations. So anybody who's got presence in India and has got a sizable export presence, or somebody who's got a presence in Europe, I think is going to benefit disproportionately for next 3 to 6 months, provided you got your coal and your power and iron ore contracts in play, which I think Tata Steel Europe already has and which some of the steel companies have. So I will not be surprised if you will actually see an outperformance which will come in Tata Steel, which up until now has been relatively underperforming. So that's what I would say is one sector you should watch out for. The theme, Aisha, I would say one should watch out for is that if there is going to be shortage of grain, if there's going to be shortage of wheat, if there's going to be shortage of coarse grain, you have to look at companies and sectors which are going to be enabling the increase of the yield. So whether it is tractor, whether it is pesticide, whether it's supply chain companies, I think for next 3 to 6 months, companies which are going to be boosting agri production directly and indirectly, I think that play will be an obvious thematic play given what is happening on the geopolitical front. These are two themes I think one should watch out for.
Yeah, absolutely. Okay, our producer tells us Ramesh Damani is already ready. Can we go across to him and perhaps chat a little bit before the markets open? Yeah, we can. Ramesh, hi. Been such a long time.